This project is on the subprime mortgage crisis, winners and losers of the credit crisis. Predictions on the outcome, changes in government regulation. At this time, there were three proposals by the Obama administration. One was to look at the safety of the financial system as a whole. The other was to form an agency to look out for the ordinary customers. And the last was to promote free and fair markets. Though at the time there were many agencies and regulators responsible for overseeing individual financial firms, there was no one entity who would look out for the system as a whole from risks that tied these firms to one another. This would be the first time that regulators look at the system as a whole. During this period, millions of Americans were taking out home loans and opening credit cards without understanding what they were actually getting themselves into. Obama proposed an agency for the ordinary consumers that would provide clear and accurate, transparent information to the consumers. In order to create a free and fair market, gaps and overlaps in the regulatory system were closed. The Office of Thrift Supervision was dismantled, and loan originators were required to retain economic interest in loans. Economic facts: decreasing interest rates. In order to correct interest rates, a zero interest rate policy was implemented by the Fed, meaning that all rates between 0 and a quarter would be cut. Subprime mortgages given to borrowers with generally poor credit was a cause for the global economic meltdown. The banks lent money to people who couldn't pay their loans, then defaulted, causing foreclosure. Government deregulation. Federal Reserve Chairman Alan Greenspan started during former President Gerald Ford's time as president in 1976. He ran his position under the impression that financial firms can regulate themselves. Ronald Reagan made him chairman of the Federal Bank. Brooks v. Bourne was chair of the U.S. Commodity Future Trading Commission and a heavy believer on government regulations of the financial firms. In 1998, she foresaw and tried to warn Congress of the potential economic meltdown. In spring of 1998, Bourne and Greenspan met before Congress in disagreement. Bourne stood strong on her beliefs that the nation's financial firms needed regulation by the government, while Greenspan disagreed, claiming that the economy was running perfectly the way it was without government intervention. As chairman of the CFTC, Bourne wanted to be able to regulate the derivatives, which are also known as credit default swaps. Nobody knew of the dangers of the market at the time. Bourne wanted to release a concept paper that questioned whether there should be regulation of derivatives. She was warned that by doing so, the market would implode and predicted tidal waves of lawsuits, even told by Rubin that she did not have the legal authority to regulate these derivatives. In September of 2008, reality struck when long-term capital management almost failed and needed to be bailed out by a group of banks. Proof being that what Bourne was saying was true. The harsh reality was that lenders kept pushing mortgages to poor people and giving buying power to those based on credit and not real income. Mortgages were done with the help that the rising home prices would allow stretched home buyers to cash out and refinance in a new loan, trapping them into loans they were not able to afford. Instead of rising home prices, prices fell. Adjustable rate mortgages reset to their true costs. Homeowners began defaulting, losing their homes to foreclosure. This dropped the value of all surrounding homes in all areas. On October 3rd, 2008, the Emergency Economic Stabilization Act was passed by former President George W. Bush. Under it, the Troubled Asset Release Program was created, TARP. This program was designed to buy up mortgage-backed securities and hold them until they gained back some value and could be resold. The Federal Reserve committed $250 billion to guarantee against the failings of subprime mortgages issued by AIG, Citigroup, and Bank of America. The act authorized the U.S. Treasury to buy risky and non-performing loans. It was structured to help the economy get back and work towards stability again. So who was affected by the bailouts? Both individuals and businesses alike, due to high rise in taxes. So who is to blame? For the most part, borrowers in this time did not know what they were getting themselves into and really thought that they could pay back these loans. On the other hand, the mortgage companies that gave these loans knew that these people could not pay and could not afford these loans. So they were to blame. The mergers and the acquisitions. After some recorded success in 2006 and early 2007, National City Corp was acquired by PNC due to the loss in the third quarter of 2007 that the company suffered. The loss was about $19 million. In the second quarter of 2008, the company had a net loss of $1.8 billion. Wachovia was acquired by Wells Fargo after the U.S. government intervened and declared that Wachovia was systematically important to the health of the economy and could not be allowed to fail. Citigroup would provide the liquidity for Wachovia to continue operations. Merrill Lynch was soon acquired by Bank of America. With the national housing crisis, Merrill Lynch announced in November of 2007 that it would write down $8.4 billion in losses. And in July of 2008, in the fourth quarter alone, the company would have losses of $4.9 billion. Groups that were affected by the subprime mortgage. The U.S. economy was greatly affected by the subprime mortgage crisis and entered into a deep recession, causing nearly 9 million jobs to be lost during 2008 and 2009, roughly 6% of the workforce at the time. U.S. housing prices fell nearly 30%, while the U.S. stock market fell approximately 50%. European economies and other economies, such as Japan, Spain, Ireland, and Germany, were also affected. Individuals that were affected by the subprime mortgage crisis were African Americans, Hispanics, and whites. Though few actually benefited from the subprime mortgage crisis, some Wall Street executives like Angelo Mazzillo did benefit. Winners and losers of the subprime mortgage crisis. Very few people actually benefited from the subprime mortgage crisis. Those were some Wall Street executives, Goldman Sachs, early sellers and rock bottom buyers, bankruptcy lawyers, and credit consolidators. One Wall Street executive who received generous, to say the least, compensation in the amount of $68 million was Charles Prince, who was Citigroup's former CEO. Among those few who benefited, Stanley O'Neill, former Merrill Lynch chairman and CEO, received $161 million in stock awards and retirement benefits, only after his company recorded losses of $2.24 billion in October of 2007. Early sellers and rock bottom buyers. During this time, before the financial crash, prices were at its highest peak. Those who sold before the financial crisis, when prices plummeted, benefited from it. Those who bought at rock bottom prices before prices began to rise again in late 2010, 2011, also benefited from this time. Also among the short list of people who benefited were bankruptcy lawyers and credit consolidators. During this time, bankruptcies and foreclosures were at an all-time high. As a result, lawyers who specialized in this particular cases were regularly sought after. Those who did not benefit and were negatively affected by the subprime mortgage crisis were the American people, financial institutions, homeowners, construction companies, insurance companies, and the elderly. Middle to low-income Americans were among those that were most greatly affected, with 250,000 new families entering into foreclosure every 3 months. Banks and financial institutions also suffered significant losses as a result of mortgage payment defaults or mortgage asset devaluation. As of February 19, 2008, financial institutions had recognized subprime-related losses or write-downs exceeding $150 billion. Below is a chart of all the acquisitions for the time period. Homeowners were greatly affected. According to the S&P, by November 2007, average U.S. housing prices had fallen approximately 8% from their 2006 peak, and by December 2007, prices had declined by 10.4% compared to the previous year. More than 2 million families had now lost their homes to foreclosure. The financial crisis had a significant impact on the construction industry. As seen below, after 2005, construction permits for new housing units plummeted to an all-time low. The subprime mortgage crisis also caused a big impact on insurance companies. According to FBI reports, homeowners turned to arson as a way of escaping the mortgages they could not or refused to pay. The FBI reported a growth in arson of 4% in suburbs and 2.2% in cities from 2005 to 2006. Although contrary to popular demand, the elderly were actually negatively affected. According to the AARP, more than 1.5 million people aged 50 and plus have lost their homes since 2007, and at least 3.5 million more remain at risk in this crucial state of their lives. The Federal Deposit Insurance Corporation, better known as the FDIC, is an independent agency of the United States government that protects the funds depositors place in banks and savings associations. The FDIC insurance is backed by the full faith and credit of the United States government. Under the watchful eyes of the FDIC, since it was established in 1933, no depositor has ever lost a single penny of FDIC-insured funds. The FDIC insurance covers all deposit accounts, including checking and saving accounts, money market deposit accounts, and certifications of deposit. The FDIC insurance does not cover other financial products and services that banks may offer, such as stocks, bonds, mutual fund shares, life insurance policies, annuities, or securities. Each single depositor is insured up to a maximum of $250,000 and $250,000 on joint accounts. These accounts include checking, savings, IRAs, and CDs. The acquisition of failed banks by healthy banks appears to have mitigated the potentially negative effects of the bank failures on communities. Although the focus of local lending and philanthropy may have shifted, first, while bank failures and failed bank acquisitions can have an impact on market concentration, an indicator of the extent to which banks in the market can exercise market power, such as raising prices or reducing availability of some products and services. The state of the banking industry during the financial crisis. The building fear that had been accumulating for some time now evolved into full-blown panic in September of 2008. The federal government stepped in and took over the two of the larger players in the mortgage market, allowing a large investment bank to go bankrupt, bailed out one of the world's largest insurance companies, and steered a major financial institution through the largest bank failure in U.S. history. Thank you for your time.